Hi, this is Alex Mahoney with Coda Financial Coaching, and I wanted to talk about market returns and investing in an election year. And what brought this subject up is in the last month, I've seen a lot of questions on the Ramsey Facebook forums and other forums about whether or not it's a good idea to invest in an election year, whether or not it's good to save or start your 401k or even have anything in your 401k at all. The idea being that we don't know what's going to happen and things could get crazy. So the market could suddenly crash and everything you saved will have been for nothing. And what really crystallized me wanting to put this into a video was the debate this past Thursday, which I gratefully didn't watch, mercifully did not watch, but I did see clips of it. I know a lot of you probably watched it or have seen clips or memes of it, and I think no matter where you land on the spectrum, I think it's fair to say that we're not looking at a Abraham Lincoln, Stephen Douglas level debate right here. What happened this past Thursday? So that kind of kicked a lot of people's anxieties more into gear. I saw a couple memes of people posting the Simpsons Ralph character, one of my favorites, by the way, of him sitting on a bus alone and saying, "I'm in danger." So I thought that was pretty funny. But the good news is whatever craziness that you observed in that debate, whatever takeaways you got from that, there's actually really no need to worry about investing in this election year or any election year. And there's no evidence that people get burned by investing in election years because things might get crazy or there's uncertainty about who will get elected. And if you look at the historical averages, just the straight averages, actually investing in election years is slightly on average more profitable, not significantly more, not statistically significant, but that's just what actually the numbers show. And maybe, some people have speculated that the candidates or the party in power or whoever the powers may be they actually juice the economy leading up to the election to give them a better shot of winning re-election. I don't really subscribe to that theory. There's really only so much you can do to quote unquote prime the pump in the economy. And, I just want to go over a couple things that you should be looking if you want to be a more intelligent investor and know where the market is going. And so that's the first thing I want to cover. And the second thing I want to cover is, even if you don't really understand what I'm saying in the first point, the second point is that, any time to invest is a good time to invest. And so we'll talk about that. So the first point being that it doesn't really matter how the election is going, what the uncertainty is, what the candidates are saying about what they're going to do. What's much more important are the broader trends in the economy related to, one, consumer spending, two, the extent to which governments are investing, but three, I think most importantly at all, and that's really been shown in the past couple of years, is the extent to which both companies and governments and other organizations are investing in practical technology solutions. That is truly what grows the economy, is the continued investment in technology and things that actually propel society forward. It's great if everybody's can afford that vacation, and that's good for the economy in the short run. But in the end, what really propels us, what allows us to have a higher standard of living, is if technology and advances. So that last trend especially is going to really overcome what any politician says in any debate. And we've seen that in the last couple years with artificial intelligence. Other sectors of the economy in the past couple years have been stumbling. For example, Housing has been stumbling. Debt has been going up. Consumers have, though they're still spending pretty strongly, they've been pulling back a little bit, right? So, and not they're not going as strong as they were in COVID and coming out of COVID, right? So, really, what's propelled the last couple of years is the artificial intelligence boom. That's been the biggest factor in why the market continues to set record highs, right? So that's really going to really overcome anything that the government or Joe Biden or Donald Trump say that is questionable. So just keep an eye on that and other technology trends as places that are going to tell you how the economy is going to do in the next couple of years, in the next decade for that matter. So really, that's the important thing to consider when starting to invest. But let's say that there is no AI boom. Let's say that consumer spending had completely fallen off. Let's say that housing starts and construction had just completely collapsed, and because people were afraid of what was going on in the election. Let's just posit all of those things as true. And so we're getting to we're actually validating the theories that election years are bad for markets. Guess what? You should still invest. Actually, that would be in a lot of ways a reason to invest or start your 401k even more. And here's why. Because we know based on 100 years of stock market data that the stock market in the long run goes up. And if you're a long run investor, which you should be, unless you're a professional day trader or professional trader or broker, you should not be focused on the short term at all, right? You should always be long in your investments. So actually, if that was even true that market returns were down in election year, if anything, you should be pouring more money because you're getting a bargain for the companies that you want to invest in more precisely in the indexes that you want to invest in. You're getting that basket of stocks picks for a lot cheaper than you normally would. So if anything, you should be doubling down if you have that capacity in an election year. So main takeaway here, well, two main takeaways. Election years, they don't impact markets. Sorry, they're just much bigger forces at work than what a stupid politician says, right? And the second thing is, even if they did, you should be taking advantage of a down market because you, as a smart, savvy investor who's looking at the long run, are wanting to know what the stock market will be in 10 or 20 years, not in 10 or 20 weeks or 1 year. So that's all I wanted to say about this past week. And, for a lot of you, what may have been a very distressing debate and thinking about investing in this stock year, but keep on at it. Keep that 15%. If you've gotten to that baby step, keep that 15% going into your savings account, and I will talk to you soon.